So, you've done it and got the ball rolling. You set up that automatic investment into the S&P 500. Money goes in every month, like clockwork. It's a great start. You're building wealth on autopilot. But now you're looking at your portfolio and thinking, what's next? Is this it? Maybe you're hearing about AI stocks dominating the market or seeing friends chase big gains with risky picks. You're stuck between the fear of missing out and the fear of losing what you've built. What if your simple automated plan has a hidden risk and a few smart tweaks could make it far more resilient? That's what we're talking about today. How to shift from being a passive passenger to an engaged co-pilot for your financial future. Here's our game plan. We're not throwing your S&P 500 strategy out the window. Instead, we're going to build on it. First, we'll tackle the single biggest risk hiding in your portfolio right now: extreme concentration. Then, we'll talk about adding stability with an asset you might be ignoring. Finally, we'll carefully explore the world of smaller stocks, where the potential and the pitfalls are much bigger. This matters because a truly robust plan doesn't just grow. It protects what you have during the inevitable market storms. Here's a startling fact. The 10 largest stocks in the S&P 500 now make up about 36% of the entire index. Think about that. Your diversified fund is heavily weighted toward a handful of giant tech and AI companies. So when you ask, what's next? The first answer is, reduce this concentration risk. This isn't just theory. Experts warn that this level of focus means your portfolio is less diversified than in the past, making it more vulnerable if the AI trade stumbles. Morgan Stanley's CIO even states that a set it and forget it S&P 500 only strategy may not be right for most investors today. So your very first next step is a tactical retreat called rebalancing. Check your portfolio's current mix. Has your US stock allocation ballooned? The goal is to consciously sell a bit of what's done well and buy more of what hasn't, bringing your risk level back to your original target. I know, bonds don't sound exciting, but think of them as your portfolio's shock absorbers. Their value isn't about beating stocks, it's about doing something different from stocks, especially when the market gets bumpy. High-quality bonds are an excellent choice for diversifying a US stock portfolio. They historically don't move in lockstep with stocks, which can smooth out your ride. For example, during the 2008-2009 financial crisis, a diversified portfolio with bonds lost significantly less than an all-stock portfolio. You don't need a lot to start. For a younger investor, even a 5% to 10% allocation creates a bulwark of safer assets. This isn't about giving up growth, it's about building a foundation stable enough that you won't panic and sell your stocks at the worst possible time. Now, let's talk about venturing into smaller, higher-risk stocks. This is where you move from autopilot to active co-pilot. Small-cap stocks can offer growth potential and are less tied to the mega-cap tech theme, but you must tread carefully. History shows small caps tend to shine during recessions and early economic recoveries, often when large caps struggle. However, they are risky. Some small-cap funds invest in loss-making companies and can be extremely volatile. Crucially, not all small-cap indexes are equal. The S&P 600, which requires profitability, has consistently outperformed the Russell 2000, which includes many unprofitable companies. If you explore this space, do it with eyes wide open. Consider a small, deliberate allocation, not a big bet. Use low-cost ETFs focused on profitable small-cap or small-cap value companies to get exposure without the extreme risk of picking individual stocks. Let's bring it home. Your next step isn't about abandoning a winning habit, it's about evolving it. You started with a powerful engine, the S&P 500. Now, build the rest of the vehicle around it. Rebalance to manage concentration. Add bonds for stability. And if your goals and risk tolerance allow, consider a measured allocation to smaller stocks for growth. The single most important point is this: true, long-term wealth isn't built by chasing the hottest trend. It's built by a disciplined, diversified plan that you can stick to.